All right, folks, you might want to sit down for this one. One of the most common arguments that I hear against index investing is Warren Buffett. He is the centerpiece of many discussions on stock picking, value investing, and dividend investing. If stock picking doesn't work, then why has Warren Buffett been so successful? Warren Buffett loves dividend-paying stocks. Warren Buffett says that diversification is protection against ignorance. Buffett is a wealth of wisdom, knowledge, and experience. He has also truly been one of the greatest investors in modern history, based on his track record. These are facts that cannot be disputed. However, both Buffett's wisdom and his success are often taken out of context to support the idea that stock picking is a smart investing strategy. I'm Ben Felix, portfolio manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you why Warren Buffett is not a reason to pick stocks. Fortunately for us, Warren Buffett documents his thoughts on many topics in detail in Berkshire Hathaway's annual letter to shareholders. Let's start with Buffett's view on index investing. As much as stock pickers use Buffett as an argument for stock picking, Buffett himself has long been a proponent of investing in index funds. In the 1996 letter to shareholders, Buffett offered some investment advice. Quote, "Let me add a few thoughts about your own investments. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results after fees and expenses delivered by the great majority of investment professionals." In the 2013 letter, Buffett explained the goal of the non-professional investor should not be to pick winners. Neither he nor his helpers, Buffett is referring to stockbrokers and high-fee fund managers, can do that, but should rather be to own a cross-section of businesses that in aggregate are bound to do well. A low-cost S&P 500 index fund will achieve this goal. That's a pretty clear message. Now, I know what many of you might be thinking. That only applies to non-professional investors. If you dedicate enough time to it, maybe you can be a professional too. Let me offer some commentary that Buffett does not mention in his letter. There have been many academic studies on professional investors' ability to generate superior results. I'll give you two of my favorite and some quick quotes from their conclusions. Mark Carhart's 1997 paper on persistence in mutual fund performance found, quote, "The results do not support the existence of skilled or informed mutual fund portfolio managers." In their 2010 paper, Luck versus Skill in the Cross-Section of Mutual Fund Returns, Eugene Fama and Ken French concluded through statistical analysis that few funds produce benchmark-adjusted expected returns sufficient to cover their costs. Suffice it to say that even professional investors have a tremendous amount of trouble producing consistent risk-adjusted results in excess of their benchmark. Also in the 2013 shareholder letter, Buffett goes on to explain that investing in index funds is not enough. You also need to maintain a disciplined approach. Buffett concludes that with discipline, the know-nothing investor who both diversifies and keeps his costs minimal is virtually certain to get satisfactory results. Indeed, the unsophisticated investor who is realistic about his shortcomings is likely to obtain better long-term results than the knowledgeable professional who is blind to even a single weakness. I don't know about you, but I am far more comfortable managing my own investments based on the assumption that I am a know-nothing investor, rather than assuming that I am a knowledgeable professional without blindness to even a single weakness. Buffett also seems to think that it is unlikely to find a knowledgeable professional without blindness to even a single weakness. Again, in the 2013 letter, Buffett gives us some insight into how his estate assets will be managed for the benefit of his wife. Quote, "My money, I should add, is where my mouth is. What I advise here is essentially identical to certain instructions I've laid out in my will. One bequest provides that cash will be delivered to a trustee for my wife's benefit. My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." Buffett similarly put his money where his mouth was when he made a bet against Ted Seides, who was at the time the co-manager of Protégé Partners, a fund of hedge funds. The bet was that Ted could not pick 5 funds of hedge funds that would beat Buffett's Vanguard S&P index fund over 10 years. The wager was not small either. It was a $1 million bet. Buffett won the bet in 2017 by a lot. In his 2016 letter, Buffett explained the many reasons that he was confident that he would win the bet. This is a quote from Buffett's initial challenge to hedge fund managers. A lot of very smart people set out to do better than average in securities markets. Call them active investors. Their opposites, passive investors, will by definition do about average. In aggregate, their positions will more or less approximate those of an index fund. Therefore, the balance of the universe, the active investors, must do about average as well. However, these investors will incur far greater costs. So, on balance, their aggregate results after these costs will be worse than those of the passive investors. Buffett does add, though, that some active investors will do well over time. He explains, quote, "There are, of course, some skilled individuals who are highly likely to outperform the S&P over long stretches. In my lifetime, though, I've identified, early on, only 10 or so professionals that I expected would accomplish this feat." Buffett's comment about early on is important. It's very easy to identify a successful active investor after they've been successful. The real challenge is identifying before they've been successful. While Buffett believes that there are some skilled investors out there, he has only met 10 in his lifetime. This speaks to the massive odds that are against any active investor, and what I would call the overconfidence of anyone who believes themselves to be one of these extremely rare few. Buffett concluded this section of the 2016 letter with this: "The bottom line, when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. Both large and small investors should stick with low-cost index funds." Okay, I think you get the message. Buffett thinks that you should probably invest in index funds unless you're one of the extremely rare few that might have a chance at beating the market. But I mean, come on, are you really one of those rare few? One of the other common discussions that Buffett gets thrown into is dividend investing. People seem to think that Buffett is a strong believer in dividend investing because Berkshire Hathaway owns a lot of companies that pay dividends. In Berkshire's 2012 letter, Buffett explained in detail why he does not care whether or not a company pays a dividend. I won't recite the whole thing, but Buffett walks through the math to explain why any investor could easily, based on the numbers, prefer a company that does not pay a dividend. If you want to see the math, it's on page 19 of the 2012 letter. But my point here is that Buffett clearly understands that a great business may or may not pay a dividend. Buffett himself has made the policy decision for Berkshire Hathaway to return capital to shareholders through share repurchases as opposed to dividends. Finally, I have to touch on one of the discussions that Buffett is most often thrown into. If markets are efficient, how can Warren Buffett have beaten the market for such a long period of time? This is a really good question. It was answered in a 2018 paper in the Financial Analyst Journal titled Buffett's Alpha. In the paper, the authors set out to explain Buffett's past performance in terms of exposure to known factors. A factor is a characteristic of a stock or bond that consistently explains higher average returns through exposure to certain types of risk. For example, value stocks tend to have higher average returns than growth stocks because they are generally riskier. Based on this type of information, if an investment professional generates higher returns by maintaining consistent exposure to value stocks, they are not demonstrating skill. An index fund could replicate their results. Value is one factor, but there have been many others observed in the data. The authors of Buffett's Alpha find that accounting for exposure to the market beta, size, value, momentum, betting against beta, quality, and leverage factors explains a large part of Buffett's past performance. In other words, accounting for the general tendency of high-quality, safe, and cheap stocks to outperform can explain much of Buffett's performance. In fact, controlling for these factors makes Buffett's alpha, or his ability as a manager to produce returns in excess of the risk taken through factor exposure, statistically insignificant. This is an important finding. The authors were able to show that Buffett's success has not been due to his superior stock-picking abilities, but to his implementation of a factor investing strategy. I am not saying that Buffett is not a genius. He is. He intuitively discovered factor investing decades before the academic literature caught up. The reality for an investor today, though, is that we do know that the factors exist. It is not by stock picking, then, but by maintaining consistent exposure to the factors that brought Buffett so much success that will bring you anywhere near Buffett's track record. This is a huge argument against stock picking, which this paper showed does not explain Buffett's performance, and in favor of factor investing, which can be largely accomplished using index funds. In fact, you are much less likely to get consistent factor exposure through stock picking due to the specific risk of each company. The analysis in this paper shows us that based on our current understanding of financial markets, Buffett's past performance can be recreated systematically without the Oracle of Omaha at the helm. This makes it even less likely than previously thought to recreate Buffett's success by traditional fundamental analysis and security selection. If you take Buffett's advice, you should not be a stock picker unless you have a tremendous amount of confidence in your abilities, and even then you have to go into it with the understanding that your confidence is highly likely to be unfounded. If you do wish to replicate Buffett's results, you are more likely to do so by maintaining exposure to the factors that Buffett intuitively took advantage of than by trying to mimic his stock picking process. Do you think that you can replicate Warren Buffett's results? Tell me about it in the comments. Thanks for watching. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. If you enjoyed this video, please share it with someone who you think would benefit from the information. Don't forget, if you have run out of Common Sense Investing videos to watch, you can tune in to weekly episodes of the Rational Reminder podcast wherever you get your podcasts.